You're in the Business Insurance Zone with me, Steve Savant, National Insurance columnist and financial color commentator. This week on The Biz, our monthly update series for October 2012. And on today's show, our financial industry update with special guest Ken Davis, CPA and national financial columnist.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I am your host, Steve Savant, and we're broadcasting to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me today, Ken Davis, CLU, ChFC, CFP, and CPA, and national financial columnist. Hey,
Steven, good to see you. How you doing? Excellent.
Well, you know, if you're watching Ken's stuff, he's all over the net. You know, he's got all these articles, he's got his blogs going on. And today on our financial update show for October, we got plenty to talk about. Ken, I'm just going to go right to the leading articles that are occupying the blogosphere, okay? And right now, here is the new one. I love this one. The lead article says, "Hey Fed, lower mortgage rates will only do so much." Well, let me tell you, I was promised 0.2 increase in GDP if they did QE3. Is it going to do anything about that? Oh, wait a minute. The iPhone is going to deliver, the iPhone's going to deliver 0.5% by the end of the year, they say. I mean, think about that. I just released the iPhone 5. They had 3 million in 3 days, right? Or no, it was 5 million. 5 million sales. I think that's going to destroy the QE3 numbers, right? I mean, who needs QE3? Just Apple needs to turn out a new phone every quarter.
Well, what I understand is we learned years ago that Keynesian economics doesn't work. The government loves it because it says spend, 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 and borrow, borrow, borrow. And that's what they're doing. They love to do that. They like to hand out those freebies because it makes them feel good that they can get reelected. But the fact is it doesn't work. What does work is fiscal conservatism. You know, cut the budget, give us some stable tax laws, some stable currency, you know, strengthen our country again. Let the corporations that have trillions of dollars sitting in cash because they're fearful of what the government's going to do to them next, and get out of our way and let us grow the economy and put people back to work. And we've forgotten that message, and we keep thinking that the government can bail us out. Well, there's not much the Fed can do anymore. The government really doesn't control the economy. It's like somebody standing out in the beach trying to hold back waves. You know, markets have a mind of their own, and people have a mind of their own, and governments really can't do anything.
Well, I'm thinking if you were a Keynesian troubadour, just remember, I didn't say that. Ken did.
I said it. I'll take credit for it.
Well, you'll take the heat for it too.
That's true.
Ken, here's another one. Should I use my retirement savings to pay off my mortgage?
Well, that's always an interesting question, and something I've heard from my clients both when I practice as a CPA and also as a financial planner along the way. And it really has to do with what the cost of money is on an after-tax basis. What is my interest rate? How much of a deduction do I get? How much savings and taxes? And what's my net cost of money? And then if I take that money and invest it somewhere, can I make more on an after-tax basis than what I'm paying? And the fact is interest rates and earnings are so low that it would be hard in this particular economy to do that. One thing I will caution is a liquidity factor. If you pay your loan off and that cash is sitting in your property, and you lose your job, you get into a bad situation, whatever, and you need that cash, you may have equity, but at that time they may not see you as a good credit risk. That this is something we all relate to in recent times, and you have no liquidity. So sometimes, from a liquidity standpoint, it makes sense to maybe deposit some money into a life insurance policy or some place where we can get a decent return, but can gain access within a week or two to pay off the debt if we have to. But for retired people, you know, it's really an emotional thing more than anything. They just say, hey, I've got the mortgage paid off, and you know, it's not a bad idea, especially as nasty a situation as we've had. So. Well,
I also noticed on one of the blogospheres what's hot is after the 401k disclosure of Reg 408B2. Now it's everything's revealed, or what is that?
God, you sound like an accountant, Steve. 408B2.
Hey, I'm just slinging the IRS code around like water out of a tap. Now I want to say, I saw this article, I loved it. It says, how to pick a juicy 401k plan. Well, my first response was, I said juicy. Who's writing these articles? But the reason I liked it, though, was because, yes, if I'm going to stay in a 401k plan, and I like it, especially if the employer's matching dollar for dollar, I'm in love. but I really want to be able to go and up my game on the 401k now that I know my expenses. And remember, most of Americans are in plans that are less than 100 people, so you're not going to get the leverage of the big boys.
Right.
So we need to start cherry picking which 401ks really have the best overall expense loads.
Well, and the thing is, my experience is when expenses go down, then the employer themselves is going to have to take more of the administrative responsibility because people have to get paid. So they may want to reduce fees, and I understand the desire to reduce fees, but these people actually work for a living. They have educational processes, they have management process, there's paperwork, you know, there's reporting, there's filing, you know, there's the auditors coming in. I mean, there's costs associated with doing this kind of work, and there's a great deal of liability. So, you know, put the shoe on the other foot, and the thing is, if you're doing all this work, you want to get paid, and suddenly your costs go down, well, what kind of service and administration are you going to get if it gets too low? There's going to be an issue there, too.
Well, employers are always looking for quality ways to keep key employees. And I saw this article, How to Keep Employees You Can't Afford to Lose. And Ken, I just want to just address that. There are benefits out there that we can give to keep quality key personnel. Talk a little bit about that.
Well, I think one of the things that an employer can do is, and it's not so much coming out of pocket with money, but offering to have voluntary deductions from payroll to buy benefits, to bring in competent, quality people that can help advise their employees. And the employees may still have to pay for it, but they feel good about the fact that the employer is saying to them, I care about you, and I'm trying to facilitate some sort of process for you to take care of you and your family. I'm sorry I can't afford to give you more, but at least I can do this for you.
When I think about it, we're going to come back and talk about the U.S. debt clock and truth accounting, but we have to do a show on strategies for post-election. When we come back from the break, we're going to visit the U.S. debt clock and truth in accounting. After all, I have an accountant with us. And don't forget to enroll in IULUniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Welcome to the Brokers Alliance Workshop. I'm Jessica Lopez, and that's Steve Savant. What are you doing?
I'm sandbagging standard and substandard cases for my producers for the impaired risk season.
Steve means he's holding back hard-to-place cases for submission until November.
But if your client needs coverage now, we'll have it underwritten, have the policy owner pay the quarterly premium, and then we'll resubmit it in November.
If you have cases that have been declined, postponed, or heavily rated, we'll package your case with the right company for the best offer.
So let the sandbagging begin. Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Ken Davis. And remember, you can order today's giveaways on The Biz at brokersalliance.com. And just a heads up, before moving forward with any of the ideas you always hear in our show, always consult your tax advisor or your broker-dealer compliance officer. We're talking about the U.S. debt and future financial obligations of the United States, and we're on usdebt.org. If you've never been on the usdebtclock.org, you need to go out there just as a citizen alone. Ken, about 2 weeks ago, we crossed over 16 trillion, the new milestone, and I noticed that at $1 million deficit every year, plus money, right, plus interest, we're looking at 4 years from now, the 2016 elections, whoever that's going to be at $22 trillion if we do nothing. I want you to just look at these numbers, Ken. It's $51,000 per citizen, but when half the country doesn't pay the tab, we're going to be sitting there at about $140,000 per taxpayer to pay off this debt.
Well, look at that number. It's almost 3 times the per citizen with the taxpayer. Now, I know that includes children and stuff, but think about it. Do the middle class and the people that aren't paying taxes now really believe they're not going to be taxed in the future? They're eventually going to get it and figure out that even the quote-unquote rich people really can't pay this. So guess what? It's going to have to filter down to other people that think they're getting away with something now. It's going to have to happen or they're going to go bankrupt, one of the two.
Well, when we talk about the sunset provisions of all the taxes on, I've heard you talk about this before, talk a little bit about this because I don't think the middle class gets it, that they're going to be paying the AMT tax, the alternative minimum tax. I don't think they understand this.
Well, what's going on in our tax law, all the sunset provisions, have you ever wondered why we have these temporary tax laws? Well, it's because when they have temporary tax law, when they do the budgeting, they don't have to account for the revenue loss by changing the exemption on alternative minimum tax upward, so that brings the projected debt down and allows them to spend more. Well, they keep upping the exemption higher and higher. Well, one of these years we may find that they just don't get it done, and the middle class taxpayer is going to pay what used to be called a rich person's tax. The alternative minimum tax was supposed to go after rich people. But, you know, unless they keep those exemptions up, this thing's going to hit us all hard, and it's because inflation eats away at those exemptions, and the exemptions aren't inflation adjusted. So that, you know, it comes back and slaps us in the face.
Well, when you think about it, we're looking at the usdeadclock.org, and there's a ton of information out here. And before you go into the booth, the voting booth, you need to look at this and make a conscious decision to do what's right for the country. Whatever you see that, I'm not trying to push any one side of this, just look at these numbers. It has to stop. If we don't, by 2016, the next cycle of elections will be at 22 trillion. I want to go out to another site, and it's called truthinaccounting.org. Now, notice they have the same official national debt clock at $16 trillion and counting. But look at this number. The real truth is all-in obligations, pensions, Social Security, Medicare, Medicaid, all the government's obligations are at $70 trillion, which is $225,000 per citizen obligation, as well as I'm thinking the taxpayer's got to be almost 700,000.
Yeah,
it's got to be right around there.
We saw the ratio was about 3 to 1, so you take that 225 times 3, 775. I mean, that's just depressing. That's ridiculous. And let's remember, the government can only get money to pay bills 3 ways. They can tax us, they can borrow, and they can print. And when we print, what do we get? We get inflation. We lived through the 70s in a high inflationary period of time, and it's miserable for the retired. We get the whole baby boom generation moving into retirement on fixed incomes. Can you imagine if this thing, to pay the bills, they have to go through printing money? Because the Chinese don't want to lend any more to us. They're getting tired of it, and the taxpayers are getting tired of it. So what's left is print the money. You want to talk about a regressive tax? Inflation is as regressive as it gets because it hits everybody.
Well, when we think about this, again, remember, this is an issue that we're up against it, and it affects our financial industry. It's going to affect our insurance. It already is affecting our insurance industry. I mean, if you heard yesterday's show with Eric Palmer, we were talking about the impact on low interest rate environment for annuities and life insurance. It's killing that part of our industry. You know,
I hate to say this, but it reminds me of 9/11. When I woke up and saw those planes crash into the building, what a wake-up call for us. We thought we were immune. We thought we were sovereign and that we weren't going to be touched by the violence of the world. Well, we see Greece and we see Europe and we see the problems with their balance sheets. You know what, guys? This story isn't a whole lot different than what's going on in Europe right now. And the way we're headed, it won't be long until we hit that. And can you imagine what would happen to the world? Tiny little Greece had huge impact and ripple effect throughout the economy. Can you imagine what happens when we get to that kind of debt? I don't care whether you're Democrats or Republicans, we need to stop this mess. We need to stop it now. We need to grow the country, we need to produce jobs, and we need to have people that are making money so that they can help pay this debt off. If we shrink, if we don't grow, we're headed for disaster, and it's just scary, guys. Well, the impact is really huge, and that's why this election probably really matters more than any other election we've ever had. I want us to think about this from an impact point of view, because every American's going to feel this sooner or later, and I think it's going to be much sooner than later. When you look at this number, if I'm looking at 22 trillion by 2016, what's that 70 trillion number going to look like? Ken, it's going to be out of sight. It's crazy. It's just totally scary, totally out of control. I don't get it. Remember, if you say, Steve, what are those sites? Go out to usdeadclock.org, and this is truthinaccounting.org. Both of those sites, you can see what I'm talking about and make the assessment for yourself. And remember, you can watch this show and all our shows by clicking on the red on-demand video button right on our homepage at brokersalliance.com. Well, that's the Buzz on the Biz for today. Get in the zone, the business insurance zone.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.